everybody wants the rainbow, but nobody wants the storm.
That's right.
So if you sit down and say, oh yeah, I just want to make money, go great. And then you start to determine what's the volatility or risk associated with generating that return. Oh no, I don't want that. And it's, well, okay, now we've got a mismatch. So you've either got to dial down your return or be more comfortable being exposed to risk, or learn risk management techniques, things that we teach, to mitigate those risks so it becomes a more conservative strategy, but with a good upside. And to add a further dimension to the challenge of doing that, if this is something you're doing with your partner, for example, so let's say, again, if we talked about a self-managed super, which might be you and your spouse, you could potentially have different risk appetites within there. I know with my wife and I, we've got quite an age gap between us. My wife is quite a number of years, she's 16 years younger than me. And so the investment horizon I look at versus what she is looking at are really quite different. And so that's a further level of complexity in it. But let's leave the complexity there and dial it into some practical things. So the first thing that you've suggested, a risk management questionnaire, I think is pivotal, because what you think you like may not be so true when you get asked those harder questions. Hey guys, welcome to this week's Money and Investing Show. This week we are discussing how to build a portfolio, whether you've got $5,000, $10,000, $100,000 or more to invest. Starting out the right way with your goals and objectives in mind is absolutely critical, as is having some of the nuances that we're going to share in this discussion. As always, don't take notes, make sure you take action. We'll see you in the show. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitchell Olarenshaw.
Hey, B. Good. Thank you very much. How are you?
Fantastic. Ready to go today. I'm excited about this one.
Yeah, me too, actually. We're in the business of building things in many ways, and more ways than one, that's for sure. Today, though, we're going to help our listeners build a portfolio. How do you do it from scratch? We can cover any myriad of asset class here.
It's an interesting one, isn't it? And you don't need $100,000 to do this, or $10,000. It's wherever you're at the start line. So no story, no excuse for not approaching it in this way. Doesn't matter how much dough you got to work with. You can start using this formula, which is a very, very handy tool to get started the right way.
Totally. And we'll couch this episode right from the beginning. This is a broad framework. I think around this, if you're really looking to do this seriously, you need to get educated and get advice on this as well, which will really help.
100%. The best investment you ever make is in your education. And it doesn't always seem like that at the front end. You think, I just need to get started. But if you make a couple of wrong turns in starting in what would be deemed as being the wrong way, that can be really expensive for you down the line. So getting advice and education at the front end just saves an awful lot of pain down the back end. And we'll talk more about that, I'm sure, as we get into it.
Indeed. All right, well, let's kick off. So let's put a hypothetical example here. Let's just say you're someone you're working with $100,000 cash to make the maths easy, 100 grand. First things first, you got to understand what you want out of that money. So I think setting some clear goals would probably be step number one.
Look, it is, and it's such a generic statement to make, say, oh, I'm getting involved with investing because I want to make money, but there's lots of different ways of making money. So you could be looking at strategies that have the ability to create income, or you could be looking at strategies that have the ability to create growth, or strategies that offer you elements of both of those. You could be looking at more volatile type strategies, which would need to match your risk appetite, or you could be looking for something that's very, very conservative. You could be looking for something that's very passive versus something that's very hands-on, and they're really important pivotal questions. So, income or growth, or both, hands-on or passive. And then the volatility of return. Are you looking for something that's more aggressive or less aggressive? And I think if you've been able to sit down and answer those questions, you can then shape up the type of investment portfolio that you're really looking at. So if we make the assumption that this is an investment portfolio that's in the stock market as opposed to property, although you need to have the same considerations around property. Why? And we'll deal with that now. I know we're slightly out of order, and I know how vigorous you are on syntax. Why is getting advice so important? If you've got a property that's likely to yield great capital growth, then you probably want to try and tuck it away in your super. Whereas if you've got something that's less likely to generate capital growth and create good income, that cash flow is probably more useful to you outside of super, because you can divest it into other areas. So there's a really simple ballpark type question right at the top of it. Are you putting it in your super if you've got the ability to do that, or is it outside? And that'll come down to whether it's a growth or an income type asset. Also, then if you're just about to transition into retirement, having an income asset is probably quite handy to have in your super. So there are a lot of factors at play. So if we can park property for a minute and dive right into the stock market and use that as the lane for the benefit of this.
Absolutely. Now, I think coming back to that, before you do anything, understanding how your goals marry your risk appetite is really important. So I would sit down, and you can do this online, you can do it through a financial planner if you're a little bit more serious, is take a risk appetite questionnaire. And they'll ask you some questions about different situations, and you can find out where you sit on that scale. Yeah. And if you're more of a conservative person, you're forced to then dial back your expectations.
This is so important, because everybody wants the rainbow, but nobody wants the storm.
That's right.
So if you sit down and say, "Oh yeah, I just want to make money," go great, and then you start to determine what's the volatility or risk associated with generating that return. Oh no, I don't want that. And it's, well, okay, now we've got a mismatch. So you've either got to dial down your return, or be more comfortable being exposed to risk, or learn risk management techniques, things that we teach, to mitigate those risks so it becomes a more conservative strategy, but with a good upside. And to add a further dimension to the challenge of doing that, if this is something you're doing with your partner, for example, so let's say, again, if we talked about a self-managed super, which might be you and your spouse, you could potentially have different risk appetites within there. I know with my wife and I, we've got quite an age gap between us. My wife is, quite a number of years. She's 16 years younger than me. And so the investment horizon I look at versus what she is looking at are really quite different. And so that's a further level of complexity in it. But look, let's leave the complexity there and dial it into some practical things. So the first thing that you've suggested, a risk management questionnaire, I think is pivotal, because what you think you like may not be so true when you get asked those harder questions. And most people, when they do a risk appetite questionnaire, it is quite confronting, and you go, oh, yeah, no, maybe that isn't me. And you tend to see people skew it down as opposed to skew it up. Really, really important first step.
Yeah, I think as guys too, we all like to beat our chests and say, yeah, I've got a really big risk appetite. I'm happy to club it. And then when you really do the test, and I'll throw my hands in the air. I mean, I'm not a super, I'm a little bit more averse to risk, probably than most people my age. And I understand that. But your goal.
Well for you too.
Yeah, at the moment it is. And your goals need to align with that. If I can give an anecdotal example, this is one I had in my own experience recently. We had the tariff turmoil, the market sold off a lot. And I had an amount of cash sitting around. It wasn't a big amount. My goal literally was to pay for a couple of days of my Europe holiday out of those funds with the returns that I made. And I wasn't planning on being in there for a long period of time. It was a leveraged, risky position. Within 3 weeks' time, I managed to basically pay for, say, 3 or 4 days out of my holiday. Now, that's not a massive goal that I want to make $1 million or $10 million. It's a little goal. It came true, and happy days. I got what I wanted.
Was it? A couple 100% return on your cash?
Not quite that amount. Like, it wasn't a huge amount of cash. It was good enough, and it was about 20% that I made within the space of 2 weeks.
There you go. Well, that's gonna work for you, isn't it? And again, it's interesting. And I know we've sort of talked about some of the other more aggressive strategies that you ran through that period of time, where there's a really skinny allocation to some what were out of the money calls, which would be looking pretty good for you right now too.
Absolutely.
And so, given that's a higher risk type trade, it's a far smaller allocation to it. And if it comes great, comes good, that's great. And if it didn't, well, that's okay too. You can kind of live with that. And this is important. But where do you really learn this? And it can come from experience. Being in the wrong kind of investment is a really good way of doing that. I remember having this conversation with my parents, and my father is, he's pretty conservative as an investor. He wouldn't spend Christmas. He's quite frugal. And for whatever reason, they've been hoodwinked, I think would be the term, with the advisor that they had in the UK into what we'll call with profits bonds, which effectively how with profit bonds work is that it's a bond. You put your cash down, and in 5 years' time at maturation, you get that capital back, plus you get a coupon on it, which might be 3 or 4%. The way a with profit bond works is that if the life company or the insurer that you're invested with makes a profit, and that they distribute a portion of that profit to you.
Okay.
If they don't, then you don't get that, and it doesn't perform in the way that you want. And if you leave the investment early, then you take the bark off at the market rate of what that instrument's trading at. So it's one of those things you got to hold to the end, but it may or may not perform depending on market conditions. And they were in that, which I said to them when they told me because my parents are independent, financially independent, and they share a lot with me. And there's some things that they go, well, we thought this was a good idea. And when I heard the advice they'd been given, it's just totally unsuitable for their risk profile, which they, went their own direction to then resolve.
Yeah.
So there's an example of something that you've got to know the product that you're investing with, and it's got to suit your profile as to what you're at. So in that instance, you're tied in for the duration of the investment, which if you're someone that needs cash for a property settlement in 6 months' time is going to be manifestly unsuitable. So it's understanding the nuances of that too. Getting back to the big things though, like if you're an investor that's looking for income or growth, so there's no one way of playing the stock market. And that's the thing. A lot of people go, oh, there's the stock market. It's kind of like going to the supermarket. There is the supermarket. But if you came out with a steak and you're preparing a meal for a vegetarian, it's not going to give you the outcome that you're particularly looking for. So in the same way, the stocks that you kind of choose to invest in need to be aligned to what your goals are. So, we're obviously based in Australia. And one of the great things about Australia is that blue chip shares yield great dividends. So if you're an income investor, the stock market is quite a passive way for you to get an income asset that's effectively index linked insofar as the stock price can move higher too, and you can protect yourself from inflation in that regard. But there are some stocks that don't play ball, that don't particularly pay dividends. And you might go, I'm just going to buy a handful of stocks. You've got to understand that they need to have a good dividend yield in order for them to work for you. You look at the US, for example, if you compare, and I think we spoke about this in one of our previous podcasts, like Altria, MO, your initials. That's right. Great stock. One of the, it's yielding about 6 and a bit percent. If you compare that to Netflix, which doesn't yield anything because it doesn't pay a dividend, if you're an investor that's looking for income, you're going to pick Altria every day of the week because it looks like it satisfies your need for income. But what you're missing out on is the stratospheric growth that you've seen from a stock like Netflix, which, over since 2022 has gone from $180 to $1,200 a share. You don't really care about a 6% dividend if your stock is 10x'd. So it's a very different type of mandate depending on what you're looking for. So you're going to build a portfolio that perhaps is loaded with the kind of stocks that's going to give you the outcome that you want. So if you're young, it's probably growth. And if you're older and in retirement or towards that, then having income flow is probably more important to you.
100%. And then thereafter, talking more about the actual product that you're trading. If we use the stock market as an example, people just think buying and holding shares or trading shares. There's so much more you can do around it. There's ETFs, there's stocks themselves, there's options that you can do.
Well, let's take options for a moment. As we've just talked about income versus growth, you can do both. And if you use strategies like cash flow on demand, which is our flagship strategy, it gives you a little bit of upside in the stock plus great income, far more regularly than dividends. Companies pay dividends twice a year, whereas you could be reefing options income out weekly, fortnightly, monthly on some of these stocks to give you much, much, much more cash flow than that which you're receiving through a dividend. And when you think about a dividend in any case, really, it's not new money you're creating. It's just moving money from your left pocket to your right pocket because the share price drops when it pays a dividend. So you lose money on your capital, but get income. So you can get taxed on it. It's kind of a bit of a misnomer for people there. Whereas with options, you're creating new direct income in addition to that you're getting from the asset. If you're not sure of what we've spoken of in the last minute or so there, come through our website, come to one of our free training sessions and let us show you exactly how that income play can work. So there's a good example of a blend. And you're quite right, going into direct stocks versus something that's more passive. So that's the sort of growth and income area of the stock market. If we look at passive versus active and being hands-on or less hands-on, using things like ETFs can give you a terrific passive way of being exposed to the market that can be largely hands-off. You just every month just put more money into your index tracking account and you're just going to follow what the market is doing, which, let's face it, it's probably going to outperform 80% of managed funds, noting that most managed funds, 80% of them underperform the market, according to CanStar.
That's right.
So you've got a way that you're going to outperform most managed funds that's totally passive, that you can easily put more money into to start growing that capital that you've got in that asset class there without needing to pour over the books and sweat about PE ratios. And I wonder what their earnings are going to be in this particular company this time around. And look, an ETF doesn't have to be a broad market ETF either. It can be very specific. If you take Jets, which is a US ETF on the airline industry, if you've got a particular predilection for investing in that, there's your ability to do it without having to choose between Southwest or American or whomever it may be.
That's right. And if you did have a particular interest in trading other asset classes within the stock market, be it bonds or property, there are ETFs which can give you that exposure. It's a very liquid and easy way to get exposure.
Low transaction fees too, compared to trading in the physical asset.
Yep. So recapping here, AB, for our listeners, we've got risk appetite and goals, and then selecting the right product. So ETFs, stocks, or options, depending on what you're looking for. The next component comes splitting that up. Now that's a really open-ended question because it depends on where you sit in all of those areas. What would you suggest for someone looking to do that?
Again, coming back to your objectives, it comes down to the time frame sometimes that you're looking at. And if you look at typical stock investing, it's deemed as being a medium to longer term type investment, rather like property. And in the case of property, it's because the transaction fees are so expensive in property, of course. But if you look at the stock market, you can be reasonably dynamic with a portion of your portfolio. And I think this is a really important learning step for people. So step one is just get going. Get going in the easiest possible way where there's the least amount of friction. And to do that, I think just setting up an account and buying an index tracking ETF is the easiest way to do that. Over a period of time, as your account grows in value and also, you're starting to make some money, your chances are your interest level will be peaked a little bit going, okay, that's actually performing kind of okay. Let's have a bit of a look at this. Carving an element of that portfolio out from maybe in an index tracker into 2 or 3 other asset classes. So maybe you do have some bonds that are sitting within your ETF portfolio, or some listed property trust to give you some real estate exposure, for example, or gold if you happen to be a fan of the yellow metal. That can all be happening in there. And I think having a little bit of a slice of your account for more speculative stuff also gives you the ability to, rather than just have meat and potatoes, you've got the ability to put some Tabasco sauce on the side with it too. Not a large amount, but enough to keep you interested. And again, to foster that learning journey where you understand and learn more about markets. And as you get older, that'll be more important because you'll have more asset that you've got to manage. And so you're going to have a higher level of understanding or skill set to do that.
100%. And I think working off a sort of a general model, and we give general advice only, of course, we typically in the trading desk talk about that 80-20 rule where, 80% of your portfolio, the bulk of it is in steady as she goes, maybe a cash flow on demand strategy, for example. The 20% you can afford to have a little bit more fun. So if it's thematic ETFs like JETS or something to do in the options market, that'll give you the flavor whilst also allowing that spread to be quite nice.
It's going to give you more of the ability to have outperformance too and add what we call an industry alpha, because if you're good at what you're doing there and you're learning the skills as you go along and you've got educated, then you've a very good chance that you could add on, significant value add on to your return through being focused in some of those kind of areas too.
Absolutely. We built the portfolio. We know what we want. We know our objectives, our risk. We've got our asset classes. The next thing is managing the portfolio. And I think in particular there is avoiding mistakes in doing that. Okay. Sometimes it's doing the opposite of what not to do is what you should do. Any key mistakes you see beginners in their initial portfolios, AB?
Scrutinizing it too closely and watching it like a newborn. Which
I like that. That's a good one.
You kind of fiddle diddle with it if you're doing that. Sometimes, and there's a difference between active and inactive investments. Watching the market on a by-tick basis is not a good way to have any level of sanity and certainly not any kind of quality of life. So it's about being able to step back and let time do its thing. Time is like a coin. There's 2 sides to it. It's either heads or tails, or in this case with time's either working for you or it's working against you. So if you've never started, time's working against you. If you have started, time's working for you. The worst thing you can do is interfere with that by getting in and out and being overly active for no particular reason other than you're riding the tape and your psychology is doing that. So, if you've got a good index tracker, just let it run. And look, the recent turmoil that we saw around the tariffs and Liberation Day, living through that as we all were and as we do as traders in the market, you see the market drop. Okay, it was like 18%, and that happened to be over, about 2.5 months. So in reality, it's not that big a correction, nothing like what the media certainly portrayed it to be. If you look at that chart in 6 to 12 months' time, you won't even remember what that sell-off was.
Well, we're not far from record highs. The S&P is...
We're recovered where we were, pretty much, and we're
positive for the year already.
And so, if you let your emotion, and we've talked about this plenty of times, get in the way, and you start, I'll trade out of it now and I'll get back in. You'll never get back in because you'll be too scared to. You miss out on those 3 or 4 key days, which I think you quoted the stat the other day. If you miss, the 5?
I think if you miss not exactly, but if you miss the 5 best days of the year, you miss out on 80% of the gains, something in that range.
So trying to overtime the market when you're new is pretty hard. So big mistake is over managing it. Just let it do its thing. The second biggest mistake is not managing it at all. So it's a seesaw to get that sort of level of supervision and oversight running at the right level. So, if something isn't performing, having a risk management strategy in play is key because your view is wrong if it's not performing. It's as simple as that. And you could argue, no, it's just the timing. But that's a get out of jail card, really. Your view has been wrong in terms of getting in there. How are you going to manage that? So, for example, let's say you have a particular view on an economy within the world, and you've used a thematic ETF to get exposure to that, and all it's doing is dropping in value. You got to cut that position. You just can't hold it and hope it turns around because your money is tied up into something that's going backwards. You can't let that happen. So it is a balancing act between doing too much and not doing enough. And that's why getting educated, and more importantly, I think being able to detach yourself psychologically from the emotion of money is crucial. And look, this, for people listening to this, you go, geez, this investing is hard work. It's not. We're just pointing out all the stuff that people don't tell you. You're not going to have an advisor that's going to sit down and tell you all this sort of stuff. We're doing this for the benefit of the fact that we work in the financial education space where we want people to be informed in the decisions they're making. And by learning a few select skills and understanding some pitfalls, you're going to be much ahead. So under managing, over managing, two big things. Next thing is not being in the right seat on the right bus. So you've got the wrong asset. You've gone off plan to buy a property, which is a fairly speculative way of getting involved with the property market, for example, instead of buying something that's a tried and tested cash flow yielder in an existing development that's proven in its integrity over a period of time. And you've picked the wrong seat on the wrong bus within the property space, for example. In just the same way, you might have picked up a tip in the stock market. Oh, you got to get some of this. And as you get into it, you watch the thing, drift down lower and lower like a leaf falling out of a tree, when you'd have been better off having a more broad, diversified portfolio for that first holding.
Yeah, and I'll add one to that as well. Speaking of diversification, I think a big thing I see on the trading desk is that people over diversify. You got $100,000, you don't need 100 stocks at $1,000 each. A, it's too much to manage. B, too many transaction fees on all of those trades. And C, it's diversification for diversification's sake. It doesn't actually lead to any alpha or outperformance.
You have to have, when something is included in your investment portfolio, you've got to have a positive reason for wanting to own that asset, not, it's there for diversification. That on its own is not a positive reason for investing. It's rather like when you pick an investment purely and simply based on tax benefit. Oh yeah, the tax benefits will be great. That on its own is not a good enough reason, because tax law, as we know right now, can change quite quickly. Kicks it into touch, not a good investment anymore. Same thing with that approach. You've got to have a reason to include it that's not simply diversification. You hear people go, Telstra is such a big company. I've got to have it as part of the ASX. It's like it's a dog of a stock. Why would you want it? It's in a dead and dying industry. Starlink will wipe it out in a couple of years' time anyway.
Yeah.
Why would you include that in your portfolio just for the sake of, we've got to have some telco stuff because it's defensive? It's like, get your money where it's going to work for you.
Yep, absolutely. And don't chase returns. Lastly, on mistakes, I think beginners, as you say, they all want the rainbow without the storm, so to speak. Yes, you can make great money in the stock market, but if you're a beginner, it's very unlikely you're going to make 200, 500% on your money in the first year.
Well, in a way, and this is going to sound maybe a bit, well, let's see how it sounds. You can judge it. But sometimes the worst thing that can happen is on your first investment, you end up having a really great investment that makes a lot of money. Because in my experience, when that happens, your confidence can really overshoot your competence, whereby, I've already made this money once, so there's a belief factor in yourself which is predicated on maybe a piece of luck. Let me rephrase that. It's not luck, because you had the courage to save the money, set up an account and hit the go button on something. So there's no luck involved in that, but you might have been more fortunate in what you chose that happened to be an absolute ripper. They're not all going to be like that. So you find that your expectation is then skewed towards that experience that you've had. And that can be quite dangerous too. So you've got to keep your feet on the ground and work on building a process and then building confidence in that process to make it repeatable, because nobody gets rich from one investment. You've got to have the ability to repeat that over a period of time. Slow and steady wins the race. Fast and steady is great too, don't get me wrong, but it needs to be a repeatable thing that goes on there, not just something that's a one-hit wonder.
That's right. Play the percentages. As my dad always said, just hit the singles down the paddock.
That's what you got to do. Keep the scoreboard ticking over and it keeps going up.
That's right. Any last practical tips for our listeners, AB, as we wrap this one up?
Look, I think having the right support network and right tools are really important. Now, what do I mean by tools? Obviously, broking account if you're buying shares, and having something that's got good transaction fees. If you're trading internationally, the ability to do that very easily without punitive currency conversions and things like that. Good reporting on your platform. Some of the basics like that, very, very, very important. Which obviously no self-ashamed plug here, that's exactly what we provide for our clients. So having that sort of tool, having the ability though, not just to have that tool, but to have a support network around you where you can pick up the phone, talk to someone that's experienced, that's licensed, that's qualified, and say, look, I'm thinking this, have I missed something? And there's a gray area, I suppose. We provide general advice. We don't provide personal advice within our broking business. At the same time, we can look at a chart with you and confirm what you're looking at, etc., to make sure that you're on the right lines, because it can be quite isolating when you're on your own doing this. So having a team and an ecosystem around you is key. And I think I'm all about people getting started. Best time to start investing was yesterday, if not today. And that's all well and good, and it's such an important overarching message, but get started right. Get yourself educated. And it doesn't have to be expensive to get educated. I think anyone that says, education is expensive hasn't priced up how much ignorance costs. Well, ignorance is really expensive.
Yeah.
And so, I'll meet people, for example, that have got a really healthy portfolio of shares, maybe a big SMSF account, and the prospect of investing an amount of money in their education. That's too much. And it's like, you got like $500,000 in the market. If you get a 10% pullback and you don't know how to mitigate that risk, it's just cost you $50,000. What price would you pay to avoid that $50,000 pain? It's like having a vaccination. It stops you getting the problem. And
that's right.
And trust me, that's the thing you want to have. I guess we've lost a few anti-vaxxers with that statement, but at the end of the day, the reality is that knowing what you're doing, knowing the rules of the game are ways of staying safe. So having that tools that do the job for you. Anyone can go to Bunnings and buy a hammer. It's knowing what to do with that hammer is key. And if you're not sure, having someone to say, no, you do it this way with this hammer is going to help you get a really good outcome. And better yet, if you've got people to say, look, step aside, I'll do it for you, or do it with you so I can show you how to do this, is a fast-track way of ensuring long-term success, which is precisely the service that we provide here. Appreciate it's a plug, but it's not a plug. It's the solution to what we do. That's why for 25 years we've been offering that particular solution to people, because we know it's what you need if you want to get the job done. And look, at the end of the day, Mitch, if you're going to be an investor and you want to build a portfolio, do you want to build a good portfolio that's been built the right way, that's going to do the job that you want it to do? Or do you want to cut corners and have something that's really flimsy, that causes you stress, that loses you money, that you don't fully have any confidence in, just because you don't want to follow a time-tested pathway of getting educated, having the right tools and support around you? Makes no sense. If you're going to do something, be good at it and get help to do that.
Absolutely. Thank you very much, AB. Cheers.
My pleasure, anytime. There you have it, guys. Make sure you like, comment, subscribe. Most importantly, hit the notification button, and we'll look forward to hosting you next week.